guys. I thought I would try and go through one of the lab problems for you, not the ones that you're assigned, but a very similar one. And this one's on page 104. It's P235B. And it is, as most of the businesses are in Chapter 1 and 2, brand new businesses that the owner is just opening up. And this one is no exception. There are a couple of exceptions, but this one's just a regular brand new business. So I'm going to go through each journal entry, asking the 3 questions, and don't worry, after a while you won't have to ask yourself those questions. You'll just go through them quickly in your mind. But at first, I think it's helpful to ask yourself these questions. So I'm going to do it each time. I'm also going to put the little pluses and minuses, which you're going to leave out when you put it into Pearson. I don't think they give you the capability of doing it anyway. But this is for the month of March for a brand new business and starts on March 1st. And this is Victor Yang, MD. And he opened a medical practice and he completed these transactions, and there's a list of them. And even if you don't have the book, you can still click on anything you need within the problem in Pearson. It comes up. All these transactions would come up. If you needed to see any data tables, they'd come up. In other words, you can always do the homework without looking at the book. It's always possible. Okay, so the first one is Yang contributed $62,000 in cash to the business in exchange for capital. A typical opening transaction for chapters 1 and 2. Which accounts are affected? Just like Sheena, when she opened Smart Touch, cash and capital. Are they increasing or decreasing? They're both increasing, which means cash, the asset, is going to increase by a debit. And it's for $62,000, and then the capital, which is always increasing, is going to be credited like it always is. There's our first transaction. Looks very similar to Sheena Bright that we did in the video previously. Okay, you're going to have a lot of these for number 1 transactions for a new business. Okay? So that's the first one. And then we move on to March the 5th. On March the 5th, they paid monthly rent on medical equipment for $570. So we have to analyze it. When you see the word paid, it's a clue. Cash down. Okay? Pay something, cash the asset down. So you know that's the credit. Now where's the debit? Well, it doesn't say paid monthly rent expense, but that word, see, they can be tricky. That word is implied, that the rent is an expense. In other words, when you pay the rent, you have the expense of the rent. So, there is a debit for, again, anything that's an expense is always debited because it's always increasing, and increases on the debit side. It's the E in debt. So rent expense would be debited for $570, and like I said before, it's easy to see when you pay cash that cash is coming down, and because it's an asset and it increases on the debit side, it decreases on the opposite, the credit side. I'm going to try to write as small as I can so I can fit them all. Okay, so they paid the rent on the equipment. In number 9, in March 9th, not number 9, paid, more cash going down, right? $14,000 in cash to purchase land to be used in operations. Okay, so they bought some land. Land is an asset, right? Accounts affected. Land, they paid for it, cash. 2 assets affected. One's increasing, the land, and one's decreasing, the cash. I'm not supposed to write it before I put the numbers, but I cheated a little bit. Accounts affected, land up, cash down, both assets. Increases on the debit side, decreases on the opposite, the credit side. The amount they paid for the land, they're pretty cheap for land, $14,000. Must be small, 14,000. Okay, so we have the 9th. Okay, so we've done 3. You can see a lot faster than putting it in the Excel sheet. And we don't have to stop and make sure the equation is in balance, because if you do your debits and credits properly, it will always be in balance. You'll notice the book still makes a big deal about the accounting equation being in balance even after journal entries, but you don't have to really worry about that. You're not going to have to total it, okay? Like we did in chapter 1. So let's look at the 10th. Purchased office supplies on account for $1,500. Every time you see those words on account, it means you charged something. If you did some services for someone and they charged it on account you did services, that would mean they didn't pay you yet. That would be an accounts receivable. And we may have one of those, maybe. We'll see coming up. But right now, we're doing the charging. Our business is charging office supplies, so we're making a bill. Accounts affected, liabilities, accounts payable. No, that happens on the 10th. So that's going to be our credit, right? But what did we get on account? Office supplies, asset. And the amount of the office supplies was $1,500. And we have our bill. I'm going to put A/P for short, so we don't have to write the whole thing out. 1,500. Why am I putting 1,000 when it's 100?
I was gonna point that out.
Yeah, thank you.
There you go.
Same thing as they do in class. Hey, that's wrong. Okay, so we bought some office supplies, but we did not pay cash for them. We charged them. This is our first bill for the business. First accounts payable. Okay, the next one is going to be on the 19th. Borrowed $27,000 from the bank. So we took out a loan for business use. Okay, we took out a loan from the bank, which means we got cash, right? Accounts affected are going to be the cash we borrowed going up, but also we made a bill. When we get a loan from the bank, we call it a note. It's a note payable. So this happened on the 19th. The cash is going up by the amount we borrowed from the bank. Notice the asset increasing on the debit side. Cash is the easiest account to analyze. It's very easy to see if it's going up or down. You either got it or you paid it. Up, got, paid, down. We have our bill, our note, and that's going to be called notes payable. You're going to see a lot of notes payable. Again, the payables always increase on the credit side when you make the bill. You can see I'm not going to make it. If you're looking at the transactions, I still have 22 to 31. I'm going to have to erase, but that's okay. On the 22nd, we paid $1,400 on account. I guess we're paying for the office supplies, but not the whole thing. They're very big on that. And when you pay a bill, you don't pay the whole thing. I don't know why. They leave a balance in the account. Don't know what that's all about. Just like when somebody pays their receivable that charged with you, same thing. Don't know why. Anyway, this happened on the 22nd. It's probably the last one I'm going to fit. So accounts affected. When we pay a bill, our money's going down, and so is the bill. Okay? So the accounts payable, I forgot to put my little plus there, increases on the credit side, so it decreases on the opposite. So when you pay a bill, you always debit the payable. A/P stands for accounts payable. We didn't pay the whole thing. We paid $1,400 and left a $100 balance. Why, I don't know. And then, of course, our cash, our asset of cash comes down by the amount we paid. So, instead of trying to squeeze another one in there and going all the way down, I'm going to erase this part and go to the 28th. Doesn't take long, and then we'll finish it up, okay? So this is going to go away, unfortunately. I always need more board. Same thing happens in class.
We should have got a bigger one.
Should have got a bigger one, yeah. Okay. So now we're on the 28th, March 28th. The business received a bill for advertising in the daily paper, and it is to be paid in April. Okay, so when something's to be paid, it's definitely a liability. You didn't pay it yet. So we know we're going to have either accounts payable or advertising payable. Let's see if this has an They do. They have an account advertising payable. You can see the list of accounts if you click on the icon for it. So it does, not all problems have advertising payable. If it didn't, you'd put it in accounts payable, but we know that's going to be our credit. Our debit is going to be advertising expense, because even though we didn't pay for it yet, we did incur the expense. When you see that word incur, that means it happened. Right? Incur means it happened. So the accounts affected are advertising, I'm going to abbreviate ADV, expense. We're going to pay this next month, $220. And then advertising payable, also increasing. I'm also going to abbreviate it, $220. So expenses, of course, always get debited. They're always increasing. The payable liability can go either up or down. It's going up on the credit side. Okay, I'm going to move on to the 31st. Now we got 4 of them left. They're all on the 31st. So the first one on the 31st, revenues earned during the month included $6,700 in cash and $5,800 on account. Okay, so they're measuring all their revenue at once, okay, by the month. This is going to be what we call a compound entry. All that means is there's more than 2 accounts affected. Okay, we have service revenue. That's going to be a combination of both. Revenue is the I in COIL, the income, always increases on the credit side. Okay. The other 2, the first one, the cash, is going up, and let's see how much cash again we earned. $6,700 in cash. When you see the word earned in a problem, they earned a revenue, you always have to record that revenue credited to make it rise. Right? A revenue earned always has to be recognized when it's earned. It's called the revenue recognition principle. It's a biggie in accounting. And then we have accounts receivable. I'm going to use AR for short for accounts receivable. Also an asset, increases on the debit side, $5,800. So we had $6,700 in our first month of operation. We earned in cash, $5,800 in charges. Total, we're going to make one total for service revenue, also increasing. We know revenue increases on the credit side. A combination of the 2 is $12,500. So we have our first compound entry. Again, that just means it's more than 2 accounts. Okay, oh, I'm getting messier. Okay, this one's going to have a compound entry. We had one like this in chapter 1, at least one where they paid a bunch of expenses at once and we had to put them into the Excel looking sheet, all on the same line. So this is going to be similar, except we're going to have them as a compound journal entry. It said employees' salaries were $2,100, office rent $1,500, utilities was $350. Record this as in compound entry. So all of those, they said the numbers are all expenses. So we're going to debit them all. Salaries expense is first. And that amount is $2,100. Very similar to what we had in chapter 1 that we had to put in on the rub. Rent expense is second. Again, expenses always debited, always increasing. 1,500. And then the last one was utilities. And that one I believe was 350. Let me double check. Yep. So we can make one total for cash as a decrease. Remember, when you pay cash, it always goes down. Add up all the expenses you paid, $3,050 is the total of the three expenses that just got paid. All in one compound journal entry. So we had 2 in a row. 2 more, and I'm gonna fit them. The business received $1,000 for medical screening services to be performed next month. To be performed means you didn't do it yet. You did not earn that revenue, you cannot recognize it. If you get money before you earn the revenue, it's called unearned. The only liability that doesn't end with the word payable that I was talking about before. So we did get money. So cash is affected as a positive for $1,000. Our liability is unearned. Let's see if I can write this legibly. Not so good, huh? Unearned revenue. You'll see this a lot in many problems. You get the money before you did the work. The money gets debited. The liability of unearned gets credited. In the next chapter, you're going to see some of that unearned being earned. And as it gets earned, we'll be able to credit it. And we can lower this one by debiting it. But I get ahead. I jump ahead. Called adjusting entries. Something to look forward to. Last problem. Last transaction. On the 31st, Yang withdrew cash of $7,100. This, I think, is always the easiest. Withdrawals, right? The D in dead, always increasing, always debited. So, Yang withdrawals is increasing by the amount that he took out. I'm going to put with D instead of writing the whole thing. He took out $7,100. Kind of a lot for the first month of operations, right? And then, of course, if he's taking out money, the money's going down. So whenever the owner takes out money, cash goes down. And that's the last one for this exercise, this problem. This is very similar to the problems that you've been assigned for lab problems. And it's also a lot like the homework, except it's longer. Okay, very good. And just let me know if you guys have questions as you're going through the homework. Goodbye.